Investing in precious metals can be a strategic way to diversify your portfolio, hedge against inflation, and protect your wealth in times of economic uncertainty. This guide will provide you with a detailed overview of how to invest in precious metals, including the types of metals to consider, the various investment methods, and the pros and cons of each approach. Types of precious metals. 1. Gold. Description: gold is the most popular precious metal for investment, known for its ability to retain value over long periods. Uses: jewelry, electronics, and as a form of currency. 2. Silver. Description: silver is valued for its industrial uses as well as its role as a monetary metal. Uses: electronics, solar panels, jewelry, and medical applications. 3. Platinum. Description: platinum is rarer than gold and silver and has significant industrial applications. Uses: automotive catalysts, jewelry, and industrial equipment. 4. Palladium. Description: palladium is primarily used in industrial applications, particularly in catalytic converters for vehicles. Uses: automotive industry, electronics, and dentistry. Methods of investing in precious metals. 1. Physical metals. A. Bullion bars and coins. Gold bullion. Available in various weights, bars are typically more cost-effective per ounce than coins. Silver coins. Popular choices include the American Silver Eagle and Canadian Silver Maple Leaf. Storage considerations. Physical metals need secure storage. Consider a home safe or a bank safety deposit box. Pros: tangible asset, no counterparty risk. Cons: requires secure storage, potentially lower liquidity compared to other forms. B. Jewelry. Investment grade jewelry. Focus on pieces with high intrinsic value in gold or other precious metals. Pros: dual purpose, investment and wearable. Cons: high markups and less liquidity than bullion. 2. Exchange traded funds, ETFs. Gold ETFs. Examples include SPDR Gold Shares, GLD. Silver ETFs. Examples include iShares Silver Trust, SLV. Platinum and Palladium ETFs. Examples include Aberdeen Standard Physical Platinum Shares ETF, PPLT, and Aberdeen Standard Physical Palladium Shares ETF. Pros: high liquidity, ease of buying and selling, no storage issues. Cons: management fees, no physical possession of the metal. 3. Mining stocks, gold mining companies. Examples include Barrick Gold, and Newmont Corporation, NEM. Silver mining companies. Examples include First Majestic Silver Corp., AG, and Pan American Silver Corp., PS. Pros: potential for high returns, dividends. Cons: company-specific risks, exposure to market volatility. 4. Mutual funds and ETFs focused on mining stocks. Precious metals mutual funds. Examples include Fidelity Select Gold Portfolio, FSAGX. Precious metals ETFs. Examples include VanEck Vectors Gold Miners ETF, GDX. Pros: diversification, professional management. Cons: management fees, exposure to market volatility. 5. Futures and options. Gold futures. Contracts to buy or sell gold at a future date at a predetermined price. Silver options. Contracts that give the right but not the obligation to buy or sell silver at a set price. Pros: potential for significant gains, leverage. Cons: high risk, requires sophisticated knowledge of markets. Steps to invest in precious metals. Step 1. Determine your investment goals. Diversification. Are you looking to diversify your portfolio? Hedge against inflation. Are you trying to protect your wealth from inflation? Speculation. Are you looking for short-term gains? Step 2. Choose the type of metal. Research market trends. Understand the historical performance and market dynamics of gold, silver, platinum, and palladium. Decide based on goals. Align your choice of metal with your investment goals. Step 3. Select the investment method. Physical metals. Ideal for long-term holding and wealth preservation. ETFs, suitable for those seeking liquidity and ease of trading. Mining stocks, best for investors looking for high potential returns and willing to accept higher risk. Futures and options, appropriate for experienced investors with a high risk tolerance. Step 4. Purchase the investment. Physical metals, buy from reputable dealers or mints. ETFs and mining stocks, purchase through a brokerage account. Futures and options, trade through a futures broker or options trading platform. Step 5. Monitor your investment. Regular review. Keep track of the performance of your investments. Stay informed. Follow market news and trends affecting precious metals. Adjust as needed. Rebalance your portfolio to maintain your desired level of exposure to precious metals. Pros and cons of investing in precious metals. Pros: diversification. provides a hedge against market volatility and economic downturns. Inflation protection. Historically, precious metals have maintained their value during inflationary periods. Tangible asset. Physical metals are real assets that you can hold. Cons. No yield. Precious metals do not generate income like dividends or interest. Storage and security. Physical metals require secure storage, which can be costly. Market volatility. Prices can be volatile, influenced by various global factors. Investing in gold and silver has long been considered a safe and reliable way to protect and grow wealth. When it comes to investing in gold and silver, there are a few key things to keep in mind. First and foremost, it's important to understand the different ways you can invest in these metals. One option is to purchase physical gold and silver in the form of coins or bars. This allows you to have direct ownership of the metal, which can be stored at home or in a secure vault. Another option is to invest in gold and silver through exchange-traded funds, ETFs, or mutual funds. These investment vehicles allow you to gain exposure to the metals without having to physically own them. This can be a more convenient option for investors who don't want to deal with the hassle of storing and securing physical metal. In addition to physical gold and silver and ETFs, there are also mining stocks and futures contracts that can be used to invest in these metals. Mining stocks are shares of companies that mine gold and silver, while futures contracts allow investors to speculate on the future price of the metals. When deciding how to invest in gold and silver, it's important to consider your investment goals and risk tolerance. Physical metal is a tangible asset that can provide a sense of security, but it also comes with the risk of theft or loss. ETFs and mining stocks can offer more liquidity and diversification, but they also come with their own set of risks. Another important factor to consider when investing in gold and silver is the current market conditions. The price of these metals can be influenced by a variety of factors, including economic data, geopolitical events, and investor sentiment. It's important to stay informed about these factors and to be prepared for potential fluctuations in the market. One strategy that some investors use when investing in gold and silver is dollar-cost averaging. This involves investing a fixed amount of money in the metals on a regular basis, regardless of the current price. This can help to smooth out the impact of market fluctuations and can be a good way to build a long-term position in the metals. In addition to dollar-cost averaging, it's also important to consider the role of gold and silver in a diversified investment portfolio. These metals can provide a hedge against inflation and market volatility, but they should be just one part of a well-rounded investment strategy. Overall, investing in gold and silver can be a smart way to protect and grow your wealth in 2024. By understanding the different ways to invest in these metals, staying informed about market conditions, and using sound investment strategies, you can build a strong position in gold and silver that can help you achieve your financial goals.